Let's start with your word of the day.
It's thunderstruck because we got to get ready to rock and roll. It's the classic AC/DC song, and it's got that great opening riff, and that's how I feel this morning pre-futures, like the da na 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 na, because we are going to just blow it away this week. You got 147 S&P 500 companies reporting a PCE. It's jobs week. Everything's happening this week, so I really do think you got to pump yourself up on the way into the office, listen to a little rock and roll, and get ready to be thunderstruck.
Okay, I'm not familiar with the song, but Vicki, I got to say, I think finance is your calling, not music. just to be clear. As we talk about earnings, we got some of the Mag 7 reporting this week. Is there one of those that you think is especially indicative of market sentiment? Is there one that's going to reveal just how investors are looking at tech and the broader markets overall?
I think both Apple and Amazon will be key. I think Meta is similar to Google, so we're hoping for some good results from them. I mean, overall, you've got a broad base, or you have IT spending with Microsoft, you have discretionary with Amazon. I think possibly maybe Amazon's the biggest barometer because they hit the discretionary spending, they hit trade and tariff. They've got a little bit of everything for everyone, as well as everybody's watching Apple and China sales and how that's all going to go down and their commentary there.
All right, we're showing Meta right now. By the way, Meta moving higher in the pre-market today. Meta is actually your pick for us today. So why is Meta your pick today ahead of earnings? What's giving you confidence to make this a buy ahead of earnings?
I think that's being a little bit too brought down by concerns on the Chinese ad pullback. Yes, Temu and Shein probably have less spending, but it's only about 11% of their revenues come from China. And we look around and we say they were growing the number of ads. They're growing their pricing power per ads. They have some of the highest engagement across all social media platforms. And more frequently, people are going to social media versus search for recommendations. We think Meta's so well positioned there. And possibly also we could get a reprieve on the CapEx, maybe not spending that 65 billion. That'd be crucial. And rolling back the losses in Reality Labs, we saw some layoffs announced from there. So maybe Meta saying, hey, we no longer want to take unlimited losses in Reality Labs. Those are good things for investors. The stock has just been hammered the last 2 months after the what was it, 20 straight days it went up. It definitely gave all that back. Plus some. We're looking for good numbers, 42 billion revenue, and we think they're going to clear this little bit of a lower bar.
All right, to your point, by the way, Meta shares down about 5.5% year to date. We're also going to get a number of other companies reporting. They're going to give us a look at the consumer. We looked earlier, it was like UPS, McDonald's, Coca-Cola. Are there one of those that you think will give us a very clear read on where the consumer is at right now?
McDonald's. I think they are really pinpointing what the people are willing to spend. If we see them come out with more value meals, which was well liked, I think that's just showing again how much the consumer is under stress. I think they're a great barometer of what the spending power is of the average American consumer continues to be.
All right. I don't know if you were watching earlier, Vicki. We were talking about what could potentially be a historic reversal this month when it comes to the S&P. At one point, S&P down more than 13%. Right now, it's down about 1.5%. If it manages to turn positive, it'll be the biggest one-month reversal ever. What does that say to you about this market right now, that we can go from those lows to potentially a positive territory in 1 month?
Yeah, volatility's back. I mean, it's been an extreme month, as you pointed out. We were down 20%. Now we're only down about 10% off our highs. But it's so news and data driven. And that is what makes this market difficult. And that's why we advise investors not to panic and sell, because things are happening so fast. And if you miss those rebound days, that's extremely painful for your overall total return. So even though it was really miserable this first part of April, seeing these rebounds, you got to be willing to take a little bit of short-term pain, because we're going to get jerked around by headline news. Expectations right now have been all good news. We're going to get deals done. We're possibly at peak tariffs, and we'll get those rolled back with China. Bess's commentary on, hey, there's a lot getting done potentially in Asia this week. We think the administration's desperate for an economic win this week, coming up on their first 100 days. And so all of that is good, positive news, as well as, hey, you might actually get tax reform through, and earnings haven't been terrible. So we switched from this everything's doom and gloom into good news, which is fantastic for the markets.
Speaking of good news, by the way, JP Morgan out with a note earlier today from Dubravko Lakos. I want to read to you part of what he said. It actually kind of ties back into the idea of the S&P reversing into positive territory. He says, in part, we believe the cuts to Q1 earnings are conservative, setting up for another quarter of a 4 to 5% positive EPS surprise on resilient demand, including front-loading effects from tariffs, better than expected net income margins, and strong capital reinvestments. Do you see this earnings picture being a similar setup right now, that we could be set up for a surprise, which I imagine could possibly help the S&P push into positive territory?
I do, because I think Q1 is a little bit safer than the rest of the year. Obviously, Q1 came before all of the extreme tariffs, and so Q1 has been a lot stronger than people anticipated. However, there's so much concern. You know, if you look at what's coming through, the number of ships in the ports in the West Coast, this potential supply chain car crash that we're going to experience the next 3 to 4 weeks if we don't get a deal done. You know, there are concerns on what does the rest of the year play out for you. So yes, Q1 has beaten that bar, and that's good, but the concerns on how resilient these earnings are if we see this massive shift in supply chain issues that we could potentially see if we don't get ships coming in from China in the next few weeks.
All right.